Hey everyone, welcome back to Corporate Decoder, where we get to the bottom of whether a company is secretly stockpiling gold or just really likes paperclips. Today we're diving into Allegro MicroSystems' latest quarterly report, and let me tell you, it's got some interesting moves. Allegro MicroSystems is releasing their quarterly report. A look at how they've been doing financially. Think of it as a financial checkup for the past 3 months. Let's start with their balance sheet. This is like a snapshot of what Allegro owns and owes at a specific moment. It gives us clues about their financial health. Looking at their total assets, which is everything the company owns, it stands at about $123.9 billion as of June 2025. That's a slight dip from earlier in the year when it was closer to $122 billion. On the other side, their total liabilities, or what they owe to others, are around $465 million. This is also down from about $490 million back in March. So they've managed to pay down some of what they owe. Now, for what belongs to the owners or shareholders, that's called equity, and it's about $922 million. It's a bit lower than the $930 million they had in March, which is mainly due to the net loss they reported this quarter. Next up, the income statement, which tells us how Allegro performed in terms of making money and, well, losing money over the last 3 months. Their net sales, the total money they brought in from selling their products, were $203 million. This is a pretty good leap from $167 million in the same period last year, showing they're selling more stuff. However, after paying for the cost of making those products, their gross profit came in at about $91 million. That's up from $75 million last year, which is good, but let's keep an eye on how much of each sales dollar is left. Here's where things get a bit shaky. They had an operating loss of $27 million. That means that after covering all their business costs, including research and selling expenses, they didn't make a profit from their core business operations. This is a lot better than the $10.6 million operating loss they had last year, so they are improving, but still in the red here. After accounting for interest and other expenses, their loss before taxes was about $10 million, $16 million loss they had last year. And finally, the bottom line, their net loss attributable to the company was $13.2 million. While this is still a loss, it's a significant improvement from the $17.7 million loss they reported in the same period last year. So the bleeding has slowed, which is a positive sign even though they aren't profitable yet from a net income perspective. Now let's look at comprehensive loss. This includes things that affect equity but aren't from the main business operations, like changes in currency values. Scroll comprehensive loss attributable to Allegro MicroSystems Inc. Storage of their total comprehensive loss was about $8.6 million. This is much better than the $20 a big reason $8 million comprehensive loss they reported last year. A big reason for this improvement is a positive adjustment from foreign currency translation, meaning their international business holdings gained value on paper due to currency shifts. This is a common factor for global companies like Allegro. The statement of changes in equity shows how the shareholders' stake in the company evolved. As of the end of the quarter, their total shareholders' equity stands at about $924 million. This reflects the net loss they incurred, which reduced retained earnings and also balances out the positive impact from foreign currency adjustments in other comprehensive income. The cash flow statement is super important because it tells us where the company's cash is coming from and where it's going. It's the lifeblood of any business. Allegro generated a healthy $61.6 million in cash from its day-to-day operations. This is a significant increase from the $34.2 million they brought in from operations last year. This is a really strong sign that the core business is becoming more cash positive. When it comes to investing activities, they spent about $10.6 million. This is likely for new equipment or property to support their business growth. It's pretty much in line with the $11 million they spent last year. On the financing side, they used $44.2 million. This was mainly due to paying down some of their loans, specifically $35 million towards their term loan facility. They also paid out about $9 million for taxes related to stock awards. Putting it all together, their total cash position actually increased by about $8.3 million during the quarter. This means they generated more cash than they spent, which is a great sign of financial health, especially given the operational improvements we saw. Allegro operates as one single business segment. This means their top boss, the CEO, makes decisions for the entire company as one unit, not by breaking it down into different parts of the business. They look at the overall profit and loss to make decisions. Looking at where their sales come from, the automotive market brought in $144 million, which is an increase from last year. And their industrial and other markets generated $59 million, a significant jump from $40 million last year. This growth in industrial and other sectors is a really encouraging sign of diversification. Breaking down sales by product, magnetic sensors or MS brought in $129 million. Their power integrated circuits or PIC was strong too, with sales of $74 million. Both product categories saw solid growth compared to the previous year. Now, let's talk about debt. They have a term loan facility, and as of June 2025, the outstanding amount was about $310 million. This is down from over $344 million in March, showing they are actively reducing their debt. They also refinanced their term loan facility in early 2025, which means they got a new loan to pay off the old one, often with better terms. This new facility is for $375 million and matures in $2,005 million and matures in 2030. Allegro made payments towards this new loan in April and May. They also have a revolving credit facility, which is like a credit card for businesses where they can borrow and pay back as needed. As of June 2025, they had no outstanding borrowings on this facility, which is fantastic. It means they have access to funds if they need them, but aren't relying on borrowed money just to keep the lights on. In terms of legal matters, Allegro states they are involved in the usual kinds of business lawsuits and claims, but they don't expect any of them to seriously harm the company. They regularly review these and set aside money if a loss is probable and can be estimated. This is the part that shows how much of the company's profit or loss is tied to each share of common stock. For the quarter, this was a loss of $0.07 per share, which is an improvement from the $0.0 loss per share last year. This improvement aligns with the overall reduction in their net loss. Allegro also grants stock awards like restricted stock units. As of June 2025, they have about 3.28 million of these outstanding. This is common practice to reward employees and align their interests with the company's success. Their income tax provision was about $3.2 million this quarter. This actually resulted in a negative effective tax rate of almost 32%. This negative rate is because they are reporting an operating loss, and tax laws often allow companies to benefit from losses through tax credits or by reducing their taxable income in other ways. Looking at their cash position, Allegro has $129 in cash and equivalents. This is up from $121.3 million at the start of the quarter. Their working capital, which is current assets minus current liabilities, is a healthy $26 million. This shows they have enough short-term assets to cover their short-term debts. Management believes their current cash is enough to fund operations for the next 12 months, and they may seek more funding if needed. This is a pretty standard statement for companies, indicating they have a plan for managing their cash. I already mentioned this, but the $61.6 million in cash from operations is a really key number. It means that despite the company's overall net loss, the actual business activities are generating more cash than they are consuming, which is a great sign of underlying operational health. They spent $10.6 million on property and equipment, which is necessary for growth. It's not a huge amount, but it shows ongoing investment in their physical assets. The $44 million in financing cash outflow was mostly debt repayment, which is always a positive sign for investors, showing they are deleveraging. Allegro states there haven't been any major new risks since their last annual report. This suggests stability in their risk landscape, though it's always important to remember that risks are constantly evolving. Finally, we have the certifications from their top executives, the CEO and CFO, confirming that the financial reports are accurate. This is a legal requirement and adds a layer of accountability. Overall, Allegro MicroSystems seems to be on an upward trajectory. Their sales are growing, and importantly, they're generating more cash from operations. While they are still reporting a net loss, the magnitude of that loss is shrinking significantly, and they're managing their debt quite well. The improved performance in their industrial and other markets is a particular bright spot. The fact that they aren't using their revolving credit facility means they have financial flexibility. The main concern remains profitability, but the trend is positive. The increase in R&D spending and SG&A, while contributing to the loss, is likely an investment in future growth and product development, which is typical for a tech company. Allegro is investing in its future, and that's generally a good strategy, though it does impact short-term profitability. So what's my take? Allegro MicroSystems is showing promising signs of recovery and growth. They are growing sales and improving their operational cash flow. The key will be to translate this into net profitability. The company has a solid foundation with strong market positions, and their investment in new products and markets appears to be paying off in terms of sales growth. Keep an eye on their ability to manage costs while continuing this growth, and most importantly, achieving net profitability in the near future. What do you think about Allegro's performance? Are you excited about their growth or worried about the ongoing losses? Let me know in the comments below. If you found this deep dive valuable, please give this video a thumbs up and subscribe for more of these corporate breakdowns. And don't forget to join our Discord community linked in the description to continue the conversation. Thanks for watching, and I'll see you in the next one.